Investing at its core is simply about committing some of your capital to something with the intention of increasing its value over time. This implies owning an asset whose value you expect to increase during the period that you own it, so that it can be sold to someone else to realize that value for you, and/or from which you expect to receive an ongoing income during your period of ownership. There are many different areas in which individuals can invest. For example, property, gold, stamps, antiques, and even classic cars. However, here we will focus on one of the most common, that of the capital market, in which people trade securities. A security is a certain type of tradable asset. There are two main types, bonds and equities. Bonds are about lending. You lend money to, typically, either a corporation or a government, and it repays you after a number of years, plus some interest for your trouble. This compensates you for doing without the capital during that time. Equities, sometimes called stocks or shares, are about ownership. You buy them with some of your money, and in return you get to own a bit of a business and a share of its future profits. That is, if it makes any. Let's say that I own a manufacturing business. Unfortunately, no one is buying my product at the moment, and consequently, the business is running out of money. Outside of ceasing operations, I have two options. I can ask my bank if it would like to swap having less money in the short term for more money in the long term. Or I could ask my neighbour if he would like to swap some of his money for some of my business. In either case, the terms on which I can obtain money will depend on their expectations for the business. If things are not looking good for my business, the bank will probably want to charge a high rate of interest to compensate it for the risk, while, for the same reason, my neighbour will want to own a large proportion of it in exchange for giving me the money, so that if things improve, he will be entitled to more of the future profits and thus be able to recover his investment more quickly. Thankfully, there is a resurgence of interest in my product, and the business becomes profitable overnight. The business becomes so profitable that soon I need to build another factory. However, I don't have enough money to build the factory, and neither does my neighbour or the bank, so I'm in a similar position as before. Big dreams, limited capital. Fortunately, there is a market I can go where people will trade their money to own a bit of the business or for the promise of more money over time. The capital market. If I am happy to give up part of my business and its future profits, I could trade a bit of my current ownership to investors in exchange for some of their money. As an owner, they should receive a share of any profit the business makes, and if the business becomes more profitable, which makes it a more attractive investment, as future profits might be expected to be higher, they could sell their little bit of ownership, their equity, to someone for more than they paid originally. However, if the business is not successful, their return could be less than they originally invested, and in extreme cases, they could lose all their investment. Alternatively, if I don't want to give away any ownership of the business, I could ask investors in the capital market for a loan. This would be called a bond. A bond is valuable for investors because they would annually receive a percentage of the original amount lent in interest or coupon payments, as well as having the original capital returned at the end of the loan term, assuming that the business is still able to pay it. However, unlike a bank loan, this bond is a tradable asset that can be exchanged with other investors for money at a price which will reflect investors' expectations for how likely the business is to be able to meet its interest and capital repayment obligations, and how attractive the expected return is in the prevailing economic environment. For more information about investing, please see the Bloomsbury Guide to Investing or reach out to us directly.